Hey, good morning, everybody. It's Hammer. Today is Tuesday, December 9th, 2025. I, of course, am Hammer, the founder of Originator Success, Grab and Go Social, and Rate Sensei. 3 awesome products to help you to build your business, to build your reputation, and get loans online, to build your social presence and get loans on social, and all cool rate stuff. Remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern time on Facebook and YouTube as we get out there and share with you what's going on in the markets. If you're here this morning, say good morning. If you're watching on the replay, do me a favor, give me a hashtag replay in the comments. If you'd like to join us live, remember you can get a reminder so you don't miss us. Sign up at hmmr.io/reminder. We'll send out a text message as I'm going live. I'll send you that out. You can also sign up using this cool QR code over here. If you're on your phone now, take a screenshot, go back to your photos, press and hold that little doohickey, and it'll bring up the link for you. Also, while you're signing up for things, make sure you're signed up for our daily email. We do send out an email each and every weekday morning. It comes from hammer@ratesensei.com. So if you sign up and you don't see it, make sure you've checked your email for hammer@ratesensei.com. You can sign up at ratelockadvice.com or use the QR code. Also, as we're talking about rates, you should check out our text alerts, www.ratetextalerts.com, where we send out a morning and afternoon text message and then alerts when there's a lot of risk of reprices. So if you're here this morning, say good morning. Let's go ahead and say hi to all the live folks here this morning. Got a question of the day for you also, by the way. The question of the day: what happened at a bar called O'Malley's? What happened at the bar called O'Malley's? And if you need a hint, it was a plan. What was planned at the bar called O'Malley's? Let me know in the comments if that rings a bell, if you recognize it, if that rings a bell for you. Curious about that. So let's go ahead and say hi to all the live folks here, all of my friends. I have to get started when I pull on. I clicked the wrong one. There you go. Let's go ahead and say hi to the live folks. We've got Megan Bissell. Good morning. Eric McDonald. Good to see you. Rob Stewart. Happy Taco Tuesday. Mallory Fotiatis. Good morning. Deb Dickinson, great to have you here. Nicole Semerad, Michael Scott Love, great to have you. Yasmin Martin, good to see you. Amy Blauser and Zane, what's up? Going on? How's school? How's life? We've got Brandy Brickler. Zane, you're going to have to ask your mom about the bar called O'Malley's because I don't think you'll know this one, but see if she does. Rob Smith, good morning, sir. So y'all tell me in the comments if you guys recognize what happened at the bar called O'Malley's. What was planned? Randy Teakle, good morning and giddy up, sir. All right, so let's go ahead and get started, jump into the good stuff, and we'll come back and answer the question of the day. So here you are. Taking a look here, we will start off with a quick recap of what happened yesterday. Yesterday, you could see here, we had a little bit of volatility early for mortgage bonds. As we came out with pricing right about here, they dropped. Dropping is bad. That means rate sheets were worse. And actually, if we go ahead and take a look, you will see that rate sheets were indeed worse. We went from about 6.25 jumping up to about 6 1/8. This is, I got to tell you, this is a little bit of an overreaction if that's what we're finding on rate sheets based on how much movement we saw in bonds. Because when we take a look here, we went from 101.28 down to about 101.03. So you're down about 25 basis points. But when you look here, we were at 101.13 the day before, down to 101.03. You're only down about 10 basis points here. So if you saw that much of a move, it shows that lenders, we crept up 1/8 of a point between, here and here. That would make sense to me, but that jump right here is a little bit extreme. But I mean, that's, sometimes how it happens. So, but like I said, bonds did have early losses yesterday. The good news is they did settle down after 10 a.m. So you can see here things were a little more flat and flattened out. Basically ended the day about the same as when pricing came out right about here. So that sets us up for today to, kind of rate sheets will react to whatever movement we see this morning. Now, this morning, we're down about 5 basis points on the morning. So, you would, in theory, rate sheets are going to be a little bit worse, but it's 9:37. JOLTS data comes out at 10 a.m. So depending on how and if we get a reaction to the JOLTS data, you could see a little bit of a recovery or a little bit of a loss. So, y'all, you need to tell me. Nobody has told me what happened at the bar called O'Malley's. There was a plan. Don't you guys remember the Pina Colada song? At a bar called O'Malley's, where we'll plan our escape. Come on. Could you tell what I was listening to right before I got on here? I was listening to The Blend, a little Rupert Holmes. Rupert Holmes is who sang that one. So anyway, taking a look at the 10-year treasury yield, we are, a little bit better. Yesterday, we were at 4.16. Now, looking at the technicals, see this green line right here? That is the 100-day moving average. That is at 4.16. And yesterday, the 10-year ended the day at 4.16. It was testing that average. It's pulled back a little bit from there today, which is kind of what I'd expect. But the technicals are going to take a back seat starting tomorrow when we get the Fed meeting. So as far as mortgage-backed securities, they're a little less rosy this morning. Yesterday, they were testing that 50 and 25-day moving average support levels here. They did end the day right about at those levels. Today, though, down a little bit worse than that this morning. So, Nicole Samurai, I can't believe you didn't get that one. Sometimes it's just context. I should have hummed the tune. Tim Klyla, good morning. Krista Reeser, Kim Mason. Baseball season, dude. You play baseball? What position do you play? I am not a big baseball person, more of a football guy, but that's very cool. All right. So as we keep going, let's take a look here and see what we've got next. Let's go on to today's calendar. So as far as what kind of movement we could see today, we've got the ADP Weekly Pulse came out at 8:15 this morning with a little bit more jobs created. Now, that's a new report. I wanted to go over that one because it's kind of a little confusing. Actually, let me see if I can zoom in on this a little bit so we can read it a little better. All right. So basically, this was, what they came out with back in October. ADP came out with their announcement that they were coming out with the new weekly labor market pulse. And they talk about how they've got their monthly, the monthly data, the monthly number of jobs created. But they were talking that there's a need for, something a little more timely. So this newer one, the NER Pulse, the mission of the ADP research is to make work more productive through data-driven discovery. And let's go back and see where it is. So we're going to continue to publish the national employment report each month. This report is built on a reference week, includes the 12th day of the month, typically publishes the first Wednesday of the month. So that's the one we're used to seeing. And then now we're going to get the new one. 3 times a month, Main Street Macro will release preliminary estimates. So this is a new weekly report that we've been seeing. And I haven't really talked about it. I'm not seeing a lot of reaction to it, but it is there with preliminary estimates of the week over week change in employment based on a 4-week moving average. So this is kind of the key. So it's a 4-week moving average, and it's what's the week over week change with a 4-week moving average. These releases will have a 2-week lag time. So the data is old, but it's only a couple weeks old. So basically you're looking at about 6 weeks because you got a 4-week average and a 2-week lag time to allow for more complete and accurate estimates of real-time employment trends. So, and that data this morning, it came in higher. So there were more jobs created this week. So just one of those small things, but we are seeing, we get the JOLTS, the job opening labor turnover survey data. That's coming out at 10 a.m. Remember, this JOLTS data, this report, this one is going to have a little bit of a unique spin to it because it skips the September and it goes into the October data. So it goes, and we know there was less collected through that time. So there's no November data on this one yet. This is still October data coming all the way out in December. So markets might not have a strong reaction to this because It's old data. We also know that the Fed not going to change on anything. Reprice risk on the day is low. It's not likely that we have to worry too much today. Bonds shouldn't be too active. Starting out the day a little bit worse than what we want to see. That's not a positive thing here. Again, we're down about 5 basis points, but unlikely that we see a big sell-off. Unlikely that you see any risk of repricing today. As far as the Fed outlook goes, the Fed meeting starts today. The big action tomorrow. We've already got some articles going on there. If we take a look, though, at potential Fed activity, again, this is going to be the December meeting. Right now, we are at 3.75. Markets are expecting, oh, look at that. Look at that. Wow, what a change. Oh, there we go. Okay, that's why. I was going to say, what, that was different. All right, so markets are expecting a 25 basis point cut. 90% expectation. So it's basically fully priced in, already priced into mortgage rates, already priced into the markets. There was an interesting article about how we could see more of a reaction, wild stock trading after the Fed decision. I don't know that I agree with this one as much, but they're saying we could see more movement based on the volatility around the decision and what's going to come next. Now, the other big deal, though, that you're going to start hearing a lot of is we always talk about the aviary when we talk about the Fed. We talk about all the birds, right? So we've got doves, we've got hawks. Sometimes you have black swan events. And now we've got one more bird. That is the lame duck. So we have the lame duck. And that is, I think, what you're going to see kind of a focus on. The question is, will the Fed move again before Powell is out? So Powell's got 3 meetings here, January, March, and April. And then this April meeting is literally days before his position is over and someone will take over. The new nominee will take over in May. And right now, that new person is suspected to be Hassett. We will see. But by the time we get to this June meeting, that's when you will have a new Fed chair. Now, remember, the Fed chair does not make this decision on their own. This is part of a committee, and that's where tomorrow's meeting is going to be a little bit kind of chaotic as well. We're going to get the dot plot. So every quarter we get a dot plot. That's all 19 Fed members putting out there what they think rates will be at a year from now, 2 years from now, 3 years from now, and beyond, right? So the expectation is that we're going to see that dot plot be all over the board. An unusually divided Fed expected to deliver a rate cut. So that's kind of what we're here. Despite unease among voters, Fed Chair Jerome Powell appears set to lower interest rates again and signal a higher bar to further easing. And I think that's really the message that we're going to get. I don't think tomorrow's Fed meeting is going to be good for mortgage rates. I don't think we're going to see them go lower. I think we could see similar behavior to what we've seen in the last couple of meetings where they go higher. Based on that, though, it's tough to imagine that rates will move much lower, but I do think they will continue to stay kind of where we've grown used to seeing them in that, low 6 range for conventional conforming, a quarter to a half a point better for govies. If you take a look here, right now we're creeping, up a little bit, but we're still, look at these numbers. I mean, you're talking everything below 6 3/8 for everything being locked in. This is optimal blue. It doesn't show if there's any points being used on these. So keep that in mind. But, we did have a little bit of a lower area here before the meeting last time. Another one, we hit a little low area here. Before the Fed meetings, but it's not likely, when we looked at these different Fed meetings, we had the October meeting, 28th to the 29th, and the September meeting, the 16th to the 17th. When we go back and take a look at optimal blue and see where does that stand, you've got the 28th, 29th, we had that low point here, 16th, 17th, we had that low point here. When you look at Mortgage News Daily, rate sheets look to have been even a little bit friendlier for that time frame. Let's go ahead and tighten this up. All right, so if we take a look here, there was that area right before the Fed meeting, Notice that we are much higher this time. We're not seeing that trend that we saw before the last previous Fed meetings where things were coming down and dipping down. We haven't seen that yet. We're likely to see at least a little bit of improvement today and some improvement tomorrow, but this could be a precursor of what's going to happen from here. And we could see things where rates continue to creep higher. And I think it's a very real possibility. So loans closing later on, we've got a lot of data next week. You're going to have the CPI inflation data. We're going to have the, BLS jobs data. But if markets are not expecting the Fed to make any moves off that, how much of that data is going to react in the bond market? So it may be, we're cautiously floating. I got a dirty mouse. We're cautiously floating into the Fed meeting, but it may be, I definitely would have my finger on the lock button for many loans tomorrow. And anybody that's really risk averse, we could go ahead and talk about being locked in before then. So keep that in mind. Randy said, what was yesterday's impetus for, rates rising? I don't think there's a clear reason why rates went up a little bit, Randy, yesterday. We're just so used to stability. The reality is that, you're talking the last few weeks here, we peaked December 2nd, bonds were at 101.20. December 3rd, they were at 101.28. So in the last week or so, we've dropped down 25 basis points in price in bonds. And you're seeing that as about an eighth of a point in rates. But there's no real impetus to this. It's just, people coming to the same position as what I've shared, which is the Fed's already likely taken the last action we're going to see for a while. And we're not likely to see Powell push for rate cuts unless we see really weak jobs data, really, a slowdown in inflation. This is probably it for a while. There's also, you could argue about the money that's been spent on AI, where the stocks are at, all that kind of stuff playing a bit of a role in there. But there's no huge thing on there. Tom Stafford said, assuming we float into it, what time to lock if things change, but thoughts on longer disregard? That's actually, I'll answer it again because it's a great question. So assuming we float in to the meeting, right? Anything closing near term, I would absolutely lock at the first sign of trouble. So I don't think we're going to see anything negative happen when we get the actual Fed minutes, because I think everything's going to be on track. We already know that the different Fed members are all over the board. So the dot plot is going to be all over the board, right? So, that dot plot is basically anonymous reference points of where people think things are going to be. So markets expect that to be all over the board because they know that the Fed members are all over the board. We're going to expect that quarter point rate cut. The question becomes, what happens next? I think Powell signals that now that we're getting data, we need to catch up on the data. I think that's going to be one of the things he talks about tomorrow. We need to catch up on the data. We need to see more pattern in the data. He has something to hide behind with not being able to look at the past reports because of the government shutdown and not being able to get that data to have things. And I think that's kind of where things are going to be and where they're at. So anything that is risk averse, when it comes to locking loans with a longer term, the question is just how much more are you paying for the lock window? In January, I wouldn't worry that loans closing in January are going to see rates significantly higher than where we're at, but this could be the best of what we're seeing. And I've talked about that before. We're close to capping out. We may be, this 6.2, 6.20. The only time we saw better was 6.13 for 5 minutes before the last Fed meeting. This would probably 6.25-ish is probably, on using mortgages as a reference point. These are probably our base rates and our best rates. I think if the Fed meeting doesn't go well for us tomorrow, we could go back up to 6.5, but I don't think we'll go any higher than that. So if you lock in before we see that movement, then you could lock everything, anything that's closing within the next 60 days. Again, depending on how much it's going to cost you to get that 60-day lock, but it may be worth it. If we don't see the jump tomorrow, then we can continue to float. And I think the most movement will come, as it always does, during Powell's press conference. So that's kind of where I was going before, is all that other movement that's going to happen, not going to be a big deal. It'll be the press conference at about 3:15 Eastern time, after the prepared comments, maybe when he starts answering a couple questions, that we'll see the most movement. So hope that helps. Good morning, Mahan. Great to see you. Gay Veal, great to have you here. Will Patterson, good morning. Venkat Malapati, good morning. So I think I answered everybody's questions. Hopefully that's there. Join me tomorrow. We'll go a little bit deeper into what the markets are prepared for the Fed. We'll see if we get any move in bonds today. I don't think we will. I think things will improve a little bit heading into tomorrow. Rate sheet should be okay. I don't think there's an urgency to locking today. I'll throw that back up on there one more time down at the bottom. I don't think there's a huge urgency. I would float into tomorrow's action with a finger on the lock button. I don't think you got to really worry. I don't think we're going to wake up tomorrow morning. As far as where rate sheets will come today, one more time, it depends if we get any reaction to the JOLTS data. Right now, mortgage-backed securities have been down about 5 basis points the entire time for the morning. So you'll get about the same pricing as yesterday, maybe a little bit worse, a few bips, but not much. And we'll see where that goes. But if the JOLTS data, if we get a positive reaction to that, if it comes in weaker, then, that's fine. But again, it's old data and markets are already pricing in the fact that the Fed's going to take action tomorrow. So we'll see it. Live-ish, EJ McDonald. Great to have you there. So goodbye, everybody. Take care, Zane. Get to school. Have a good day at school. And everybody, have a great one. I'll catch y'all later and I'll see you tomorrow. Thank you very much. Bye-bye.